Howdy, Team 42. It's your skipper here, Darius Dale, to present another episode of Pro to Pro Live. I'm joined with our friend Andy Constan, the founder and CEO of Damn Spring Advisors. How you doing today, Andy?
I am doing great, Darius. Happy Thanksgiving to you and yours.
Happy Thanksgiving to you, my friend. It's great to see you. You're a fan favorite amongst our Team 42 community. Obviously, a fan favorite broadly speaking across our global financial services community. So I just want to thank you for all the insights that you provide and the education that you've been providing over the past few years. It's been awesome, man. We appreciate you.
Thank
Um,
you, Darius. Appreciate it too. What you do is phenomenal.
Oh, thank you, sir. I appreciate you. So, for those amongst our subscriber base that have been living under some very comfortable rocks for the past few years, can you just give a brief background of who you are and what you guys do at Damp Spring Advisors?
Yeah, sure. I spent 18 years as a trader and positioner and manager at Salomon Brothers, focusing on equity derivatives until I started my own hedge fund right before the financial crisis. That worked for 4 or 5 years, and then we closed down when our partners couldn't get along anymore. So I went and joined Bridgewater to learn macro, which was new to me, and worked for them for a little over 3 years, and then moved on to work for Brevan Howard, which is a discretionary macro firm, for a little over 3 years, close to 4 years. And from there, Alan Howard helped me launch my hedge fund advisory company, Damp Spring Advisors. And what I do there is write research and answer questions for some of the largest macro funds in the world, and I share some of that information with my public following at Damp Spring, and also offer a very bespoke, high touch product for investors who want to learn more, which you can look at dampspring.com to find out more details.
Yeah, absolutely. I highly recommend, folks. Andy's one of the best out there. So, appreciate you again joining us, Andy. So let's just get right into it. This has been a weird year. Now, I wouldn't say weird. It's been a very busy year. I don't know if you agree with this characterization, but I was having a conversation with one of our Pro clients yesterday, and we both agreed that there have been about 2 or 3, maybe even 4 full years worth of trades and returns just in 2023 alone. Just given a lot of the some of the cross currents that we've had to deal with as investors. It sounds like you're kind of nodding your head. You agree. Do you see us sort of escaping this kind of dynamic cross current environment, or are we kind of going to continue into 2024 with that?
Yeah, I mean, I think the high level point that to make about the last 3 to 4 years is that the forces of fiscal and monetary um, changes have been huge, just in terms of their scale. They have been, people use the term um, non unprecedented, but I couldn't even remember it. Unprecedented, but they do seem that way to me. And the forces aren't really going away. And in particular, the economy and the global economy is very out of sync with each other across many regions. And so I think we're going to have some, meaningful chop in markets, both up and down, next year. Um, and the real question is, and the way to avoid that sort of chop is if the global policymakers, dominated by the US fiscal and monetary policymakers, but also others, can somehow cause every economy to converge and reach stable growth and stable inflation at relatively the same time. And I just think that's given the forces, it was extraordinarily windy here today. We had a nor'easter. And that's what I feel is going on to both the economy and the markets. There's been periods of calm, and then there's been periods of gale force winds. And I don't see those gale force winds going away anytime soon.
Gotcha. And so, which of these calm or gale force winds are you sort of most focused on as it relates to kind of guiding your discretionary investment process?
Yeah. So the number one thing that I bring to the table that I think has been my edge for a while now is the amount of portfolio risk that investors are able to absorb. and how that translates that into what I call, well, what's called risk premium. Um, and there are risk premiums in every asset class, and there are relative risk premiums in foreign versus domestic assets, which affect currency levels. And so the things that are changing risk premium have been quantitative easing, quantitative tightening, fiscal policy stimulus primarily. And then this year has been all about, and it really started probably a year ago, 2 years ago, when about this time the Fed met and said that they were going to start quantitative tightening. Since then, it's all been about how does the market absorb risk as those flows around quantitative tightening, issuance, the budget have flown, gone through the economy and the markets.
Gotcha. And so give me your sort of broad lay of the land here as it relates to how you guys are currently positioned, and we can kind of unpack it from there.
Yeah, I mean, you mentioned having a year in short periods of time. For the first part of the year was pretty neutral for us, and then we made our year in 2 months. And we did that because we anticipated that the Treasury was going to, instead of muting quantitative tightening, was going to enhance quantitative tightening by their choice of issuance in July. And when they did, bonds and stock markets fell 10%. Yields rose on long-term bonds, rose 100 basis points. And we had a real major correction from July 31st to Halloween.
Yeah.
And literally on Halloween, that transmission mechanism was once again muted by the choices the Treasury made. And since then, we've basically been up, assets broadly, but equities in particular, have been up every day, maybe for the last 18 or 19 days, and are up today. And except we had one bad auction, and that was the only down dip we got. And that makes sense to me. We called buy all assets, hold your nose, buy all assets on Halloween. And the reason why we did is because that quantitative tightening was once again muted by the choice of the Treasury. And so here we are. It's been muted. It's not going to be muted forever. The markets have made a complete recovery, some markets even stronger than they were on July 31st, like the NASDAQ.
Mhm.
And to me, it's time to start layering in shorts. I've gone short. I will short more. Currently, I'm not swinging a big bat because things are too uncertain for me to know what will cause a catalyst that will reverse the rally in asset markets. I don't think seasonality is a factor. We may be able to discuss that. But I'm starting to short, knowing that come next quarter, the forces of quantitative tightening need to re-emerge. And if they don't, the Fed will have to work harder to control, keep growth and inflation from reigniting.
Gotcha. So you said a few things that I think are worthy of sort of unpacking. You mentioned that you sort of you anticipated the tighter QRA, or the more hawkish QRA back in July. We got the more dovish QRA at the beginning of October. You correctly pivoted towards long assets. We did the same in conjunction, not just on that view. We also got some very improved positive productivity data. BOJ surprised dovishly as well that week. Non-farm payroll surprised dovishly as well in terms of the labor, or in terms of the wage data as well. So it was sort of like a quadfecta of like hold your nose, buy all assets, and oh by the way, all of our positioning models were indicating that investor sentiment and discretionary investor positioning in particular was actually very light heading into that catalyst week. So here we are today. I'd love to pull on that thread in terms of what is it, what in your process are you looking for when you review the QRA, or when you anticipate changes in the QRA that'll give you an indication of whether quantitative tightening is going to be onerous or less onerous or more onerous?
Well, for me, it's all about duration issuance. So the first thing that I think is relevant is that in Q3 Q3, there was only 178 billion of new money issuance through government bonds, through longer duration, not bills, treasury coupon bonds. And the July event was that they announced that they were going to issue almost double, 338 billion in Q4. And the dovish QRA was that in Q1 they were going to issue 348 billion, which is still more. It's just not as much as people expected. I expected about 420 billion in Q1. And so I think there's still a tremendous amount of overhang of the government needing to term out its financing instead of using bills in a high deficit, high QT runoff environment, which will cause duration to have to come to market eventually. But we still haven't actually dealt with much of this actual supply. And markets have already corrected a significant amount from the lows, and we just haven't even dealt with the supply yet. So I guess the first thing, to answer your question, the first thing I'm looking at is since the rally began, we've had 5 treasury coupon issuances, if I'm not mistaken, 3s, 10s, 30s, and this week we had 10-year tips and 20-year bonds. And one of them went badly, very badly. And so what I'm looking at is, what's the next month of auctions going to look like? The second thing I'm looking at is the impact on the economy of 5% 10-year bond rates and all-time high mortgage rates in Q3, and the credit that policymakers from Lori Logan originally through to Jay Powell at the presser and in the minutes that were released yesterday, the Fed is resting heavily on higher long-term interest rates as being something that will help them in terms of doing additional keep them from doing additional rate hikes. Well, that's reversed. My estimate is that the increase in equity prices, all asset prices, drop in long-term bond yields is akin to a 25 to 50 basis point cut. So just imagine if they cut on October 31st instead of doing what they did, what the market reaction would be. And I think that's what we've seen. And to me, that is Janet Yellen working at cross purposes to the Fed. And though data that we're getting now and data that we will get for probably the next month is going to be backward looking to when mortgage rates were at all-time highs and treasury yields were at, well, not all-time, cycle highs, and treasuries were at 5 to 5.25. Markets where things were tighter. I would expect we're going to get a couple more data points that support recession and the Fed cutting. But we've had a massive easing. Mm-hmm. And so the next thing I'm looking at is both the Fed's future, the SEP that they're going to create in December, and their commentary regarding, hey, we told you that long-term interest rates were doing the work for the Fed, and now they're not. So our work's not done. They may not say that, but that's what I'm looking for them to say. And that's what I think will actually occur.
Mm-hmm. Mm-hmm. So you mentioned a couple things that I think are worthy of unpacking as it relates to the longer term outlook for interest rates, because we actually have a question, but I do want to kind of pose this to you, get your thoughts on this before we ask the question. Colin, if you don't mind throwing this slide up on the screen, slide 43 here, where we just show the 3-month 10-year Treasury yield curve being deeply inverted still at about 100 basis points, or 100 basis points, give or take. Why would the Janet Yellen be in a rush to start sort of extending duration as it relates to the net financing needs of the government? Why not just continue tapping into all that excess demand that we continue to see in the reverse repo facility balance? I want to say there's about just shy of $1 trillion of excess demand for T-bills still in the RRP. What are your thoughts on that?
Yeah, I mean, they should. The RRP is terrible financing for the government. It's a program that, really had to exist because of regulation they changed in terms of the way banks handle reserves in a ample reserve world. And the RRP needs to get drained, as do reserves, to really durably kill inflation. So I'm all for draining the RRP. And by the way, with 348 billion of bonds, they are issuing 470 billion of T-bills this next quarter. Mm-hmm. They're going to drain the RRP. It's going to unfortunately fill bank reserves, just in terms of the way the plumbing works. But so it doesn't actually drain liquidity enhance liquidity unless the banks lever themselves up. Mm-hmm. But I do think they're going to continue to tap it, and they need to. We have an $816 billion funding need next in Q1. So bills will continue to be a significant portion. But you ask a different question: why term out? And the answer is no one knows where interest rates are going. The Treasury generally doesn't market time. And if you look through history, whenever they issue a ton of bills, they work them down over time. And the most important reason, and the Treasury writes a lot of this in their work. You can just go on their website and see what they think. And when you issue a long-term bond, if you can issue at a very low, or today, as of this morning, negative term premium, you are asking an investor to take on risk of the path of interest rates with absolutely zero expected return. And so it's just cheaper to issue coupon bonds, even though by the way, the coupon is also lower than bills right now. But even if you wait and see the path of interest rates that's priced into markets, you're getting a great deal if you're the U.S. Treasury, and you're getting an awful deal if you're an investor to buy 10-year bonds. And so to me, and by the way, this is not me, this is the Treasury's literal work. They pay a great deal of attention to term premium and prefer to extend duration when they're getting a good deal. Mm-hmm. And the deal is historically good right now.
Gotcha. That makes a lot of sense. What do you make of, just kind of pivoting slightly before we kind of open it up to questions? What do you make of the sort of, this view that we're sort of past peak in terms of, fiscal issuance? If I can kind of highlight some of these fiscal policy dynamics that we've been studying, one thing we found is that, we've had obviously with record non-war, non-recession budget deficit here in fiscal 2023, but the impulse peaked quite a few months ago. If you look at it on a year-over-year basis, the budget deficit on a year-to-date, year-over-year basis was up about $834 billion in June. It was up $535 billion in August, and now it's only up about $255 billion here in October. And so you can make the case that, hey, okay, California is coming back online, and some of the tax receipts, we're not going to have the same cost of living increase adjustment as we saw in 2023. It was around 9%. We're talking about something that's closer to 3% now. We're having a much more normalized in the context of 5 to 6% budget deficits at a 4% unemployment rate, but that's neither here nor there. We'll save that for a different discussion. We're having a more normalized outlook for fiscal policy and budget and Treasury debt issuance. So you roll the clock forward 2-3 quarters from now, a lot of what we had to deal with as investors in terms of indigestion on that front may actually be in the rearview mirror. Do you have any thoughts on that?
Yeah, sure. So I think that you're talking about multiple things, but the first thing I think you are saying is that the growth stimulus is ebbing, and I agree with that completely. I don't think it's going to be a major part of the economic picture, is the growth, the fiscal stimulus as a growth driver, as a demand driver. I think it matters as a demand driver, but it certainly has peaked. Mm-hmm. So then you have to ask yourself, okay, so what does it mean in terms of issuance? And, I come from the school that says that when the Treasury issues bonds, the spending finances the bond issuance. And it's just a matter of timing from when the bond is issued to when the spending happens and the saver gets that spending and then buys bonds. So I don't think a budget deficit is on face the thing that matters to markets. Except for the growth and inflation thing, but from the term premium thing, we finance our own debt. And so I'm not doomed at all in terms of, this big deficit being able to be funded. I think it will easily be funded. I'm mostly focused on quantitative tightening because, again, I think we finance our own debt, but we don't finance our own debt when we're paying back the government, the Fed, $720 billion a year. And that's the liquidity hole that I'm focused on. So it's not the absolute size of the deficit that matters. It's where the money goes. And the money is going to the Fed at $60 billion a month and is likely to continue to go to the Fed until reserves plus RRP are down to target, which is, a number like 2.7 to 3 trillion, or quite a bit lower than where we are now. And so I don't think quantitative tightening ends for 1 to 2 years at earliest. I think 2. And that financing is the financing that the government doesn't spend to support assets. You got to pay back the Fed, and private sector's got to pay them back without any spending stimulus to give them the cash to do it, meaning investors have to lever up, and they're not being rewarded to do that.
Yeah, and so very simplistically, obviously we can have a 3-hour conversation about this stuff, but very simplistically, if the treasuries can make quantitative tightening worse or less onerous by their decision to issue coupons relative to bills, that we know. If that is the case, can we go into a scenario whereby Janet Yellen and all the folks on the Treasury Borrowing Advisor Committee are looking and seeing a disinflationary outcomes in the U.S. economy and are saying, hey, look, you don't need to be, I don't know, for lack of Principal Yellen, you can be cool substitute teacher Yellen indefinitely until we have something that looks like a more, kind of unbridled inflation outcome. Is that something that we could see in the first half of next year?
Yeah, so I mean, sure, of course, and their political motivations regarding keeping the economy stimulated and above, and jobs plentiful and markets high and all those sort of things. And I'm not really much into the Treasury doing political things to manage because it's such a tough thing to get right.
Yeah.
But of course, that could happen. So my approach has been pretty straightforward. I don't position until I see the QRA, and then I react to what it says. And so that's what I'll do again. And if she decides to go to X hundreds of billions of bonds relative to bills in the next QRA, I'll make my decision based on whether X is high or low.
Yeah, that makes sense. Colin, if you can throw this chart up, this is one of the more anomalous charts we've seen in a long time. This just shows the trailing 12-month, bills and coupons divided by as a ratio of total net marketable borrowing, and we're tracking at these very unsustainably high levels of around 70-ish% bill issuance in terms of total. And you and I both know that that's extremely unsustainable. I guess the question is, if we get, and I'm literally playing devil's advocate. Don't assume that I agree with any of this, but if we continue to get disinflationary outcomes, mostly through, in my opinion, not just through in terms of the inflation data, but if we actually continue to see productivity growth sustain itself at this slightly above trend pace, then you're going to be able to look out and see, at a credible path to a soft landing. Whether or not it occurs or not is beyond the point. If we have a credible path to a soft landing amongst not only the investor community, but amongst the Treasury Borrowing Advisory Committee that ultimately feeds its way back into Yellen's decision-making process, I guess the real question is there a risk that asset markets continue to squeeze over the medium term in the context of what, has been pretty light positioning for the, discretionary investor community throughout the year?
Yes, I mean, the answer is sure, of course. Listen, a soft landing is good for assets.
Yeah.
It's good because both Treasury and Fed can take their foot off the brake. And That's totally reasonable thing. Now, the question is what's priced? And I look at earnings growth expectations priced at 12%, compounded year over year for the next 2 years. And no, we're not going to reach those those earnings if nominal GDP is like you just described, soft landing-ish. Call it 4% nominal GDP. The makeup is not that important for stocks, but call it that. You don't get 12% compounded growth in the S&P 500 on that type of GDP. And then let's say we do get the type of GDP that can generate that type of earnings growth. If we do, there's no way inflation is dead, and there's no way that these doves can stay doves in such an environment. And so bond yields have to rise in that example. And so I'm favoring this idea of that I've done before, which is short 2-year notes and short S&P on a levered basis. And that's the basic position I'm building at this stage, because we're priced to cut 100 basis points in 2024, and that's getting the cuts starting earlier and earlier each week data point. And we have a potential duration supply that is going to tighten the economy. And equities are priced at call it 18 to 19 PE, depending on what forward gauge you use, and 12% earnings growth for that valuation. And so the two can't both happen.
You're absolutely right. You sort of called out that conundrum, I want to say maybe 18 months ago. It was a long time ago, and it's certainly been one of the reasons we've been sort of trapped in this range. I mean, it feels like 2023 has been this very positive year for stocks, not so great year for bonds. But when you pull the charts back long enough, we've been hanging out here for quite a while.
Yeah, we sure have.
Yeah, it does for quite a while now. Have had a lot of trades and a lot of opportunities to make and or lose money, but certainly on a longer term structural basis, we are sort of trapped between this rock and a hard place between an economy that's doing just fine and inflation that is stubbornly too high as a result of an economy that's doing just fine. And I want to I tip the cap to myself for inventing the resilient U.S. economy theme about 15, 17 months ago. So we had a question from our friend Marvin here. We sort of been talking about dancing around it, but it'd be nice to kind of put a Tiffany bow on it. So where do you see the 10-year yield as having peaked, and what's the primary scenario that drives yields higher? You mentioned QRA surprise next in a couple months.
Right. I mean, I guess the first thing is no, I don't. Well, I'm not sure that peaked. They could go to 5.25, 5.5, but they're not going to 6 unless something changes radically. But I do think they need to go to 5.25, 5.5, simply to create the tightening necessary to slow the economy. And at current levels of interest rates, and most importantly, term premium of interest rates, financial conditions are just too easy for growth and inflation to return durably to target. And so right now I am short 10s and 30s, small, not my biggest position, but gonna be at these levels because the economy is going to warm based on this, essentially a 50 basis point cut in interest rates that Janet did that was caused by this easing of financial conditions.
So you've been very generous with your time. Do you have like a few more minutes to kind of unpack something? Because there's something I want to pick your brain on. We're starting to do a bunch of research on the dollar as a potentially entering a bear market in the dollar. I think it's pretty early to make that definitive conclusion. But so what are your thoughts, broadly speaking, on the U.S. dollar on a medium-term basis? Do you think dollar's up, dollar down, dollar flat?
Yeah, so I don't have a strong view on the dollar at the moment. Obviously, I loved the euro. That was one of my big trades this fall. Caught that, made a nice grab on, in the 103 5 level and rode it. Maybe it was even lower. Anyway, like the euro versus the US. And I'm looking for a point to get long the dollar, but I don't think it's appropriate yet. I prefer, and the reason is I don't see the monetary tightening yet. I'd rather bet on the direct pricing of short-term interest rates, twos, in terms of cuts priced in, than go long the dollar expecting those cuts to get priced out and the Fed to stay higher for longer. And so I just like that direct bet for that particular set of risks. And then I think it is a difficult thing, more not shorter term, not in the next 6 months, but 2 years out, that as the U.S. has this deficit and continues to require foreigners to buy our assets for many different reasons. I do think there is some, a reasonable problem and for the dollar to clear the market at current interest rates in terms of issuance. So either interest rates rise to support the dollar, which is one possibility, or interest rates don't rise enough and we need to incent foreigners get incentive to buy our assets only by a weakening in the dollar. Mm-hmm. And so I think that second thing is too early to make a call on to get really bearish the dollar. But from an interest rate differential basis, it's too early to get bullish the dollar because I'd prefer to just be short twos for that, that priced in cuts issue. So that's where I come from. Now, as it relates to the dollar, you never have, it's a dollar against what? And I'm still pretty negative on Asian currencies in terms of their need to pursue easy monetary policy and easy fiscal policy. And so if I were to go long the dollar, it would certainly be against the yen versus anything else. And if I were to go short the dollar, it would more likely be against Western currencies.
Yep, sounds good. Yeah, so we're sort of in a slightly different camp. We're starting to do a bit of research on how do we create a credible path to a dollar bear market? Because to me, that's the number one risk in asset markets that I don't hear anyone talking about, is if a dollar actually has a sustainable decline, because that brings on a whole host of implications, not the least of which is we're going to have a positively, a sustained positive trend in global liquidity, sustained positive downtrend in currency volatility, bond market volatility, and obviously sustained positive uptrends in equity and credit-like assets. So let me show you 4 slides real quick here. I'll just rattle through them and kind of I want to get your sort of general assessment on this, because again, this is very new, nascent research. So, kind of the first thought, the first expectation is if we continue to get soft landing data, dollar's obviously a hard sell. I don't think you would disagree with that. You and I think it sounds like you sort of agree with me that, there's not really much to do in terms of interest rate differentials right now. Dollar's fairly valued relative to other currencies on an interest rate differential basis. It's also fairly valued relative to terms of trade in terms of how we model those things. It's quite overvalued on a real effective exchange rate basis. And this is something that, in my opinion, I think the path of least resistance is lower in the dollar. That doesn't mean the dollar has to decline in price, but the dollar needs reasons to go up from here. And in the absence of reasons, the path of least resistance is lower. Would you not agree with that? Or
is that driven by relative inflation expectations?
Yeah, exactly.
So it suggests that so I guess my concern about that is it probably suggests that U.S. inflation is not going to stay as high as it has. It's going to fall rapidly.
Mm-hmm.
Yeah.
No, it's the opposite. It's
oh, really?
It's saying that U.S. inflation, the dollar is too overvalued relative to our inflation dynamics.
Oh, okay. So will stay inflationary relative to the globe.
Exactly.
Yeah, that makes sense to me.
Yeah. And then the final chart I'll show is, which is sort of what you alluded to. This chart shows in the spread area charts the 12-month bill yield for the dollar, or for the Treasury, for the German bond, to UK gilt yield, and 12-month JGB yield. minus the Taylor rule expectation for each of those countries' policy rates. And so
Yep.
right now, as you can see, at minus 227 basis points, the dollar actually has the most support in terms of how much progress the Fed has made in respect to its fight on inflation. And so if you think about it from that perspective, there's this kind of push pull between the structural outlook from a real effective exchange rate perspective, but also this kind of push pull between, okay, the Fed is actually tighter than the rest of these other central banks, but is that the only thing that really matters? And the reason I asked that question, there's a few things that we were kind of highlighted in our global liquidity monitor this morning. You can create a credible path to a sustained up move in the euro. It doesn't necessarily mean the euro is going back to 150 anytime soon, but could you go to 110, 115? I think that's a reasonable series of expectations given positioning in the currency market and broad investor positioning. And the reason I say that is because Europe currently has the most negative economic surprises right now in the across all major economies. But they also unlike the U.S., they actually have loosening fiscal policy. The U.S. has the exact opposite scenario where they have the most positive economic surprises, but tightening fiscal policy. And so you could think about a scenario 3, 4, 5 months from now where U.S. is no longer surprising to the upside, Eurozone is no longer surprising to the downside, because again, that fiscal policy, spigot is actually improving in Europe as opposed to being taken away here in the U.S. Now, again, I'm not saying this is a hard baked thesis, but I'm starting to paint the picture of what's the number one thing that people are not positioned for right now. And to me, the number one thing people are not positioned for right now that I'm starting to see a very credible path towards is just an absolute melt up in asset markets. And again, I don't necessarily agree that that's the modal outcome, but I do believe it's a much higher probability than investors are assigning to at this current juncture.
That may be true. I think that I wonder about saying the dollar weak will cause asset melt up. That's a very loose and non-causal. It happens to often be true, but I don't see the cause for a U.S. asset rally on a weak dollar as strongly as you may do. That said, on your last chart on the euro, I definitely think that story is the story that's driven the rally so far. And to me, it's a question of how much longer that goes. Growth expectations, as you said, financial surprises were extremely negative in the Eurozone. And that's, was leading to a lot of euro weakness. And you had to get in before the weakness turned. So I'm just wondering whether, that has more to run. Because now I think you're right that you're going to see a flip, but it's beginning to, listen, it's only moved 5%. So is it priced in? No. But is it priced? A little bit. And so, that's where I'm probably neutral at this stage versus very bullish. In terms of, listen, a melt up could happen in any market at any time. And I wouldn't be surprised if it were to happen. But that's not my central case. And I think it would require a perfect soft landing.
Yeah, that's fair. That's fair. The one thing I would slightly push back on that is saying I don't know that you need a soft landing for that scenario. I just think you need the expectation of a soft landing to persist for an extended period of time to allow asset markets to get ahead of themselves and ultimately have to correct at some point later in the future.
Of course.
Just wrapping this up, Colin, if you throw this chart up real quick. So we do a lot of work on global liquidity. I know you're friends with Michael Howell over in London. I would definitely tip my cap and say he's certainly the world's expert. But I don't believe we're very far behind in terms of understanding some of these dynamics. And one of the things we found is that when we created our global liquidity proxy, which is the sum of the global central bank balance sheet, global broad money supply, and global FX reserves minus gold, what we find is that it's highly co-integrated with asset markets. It's not a good trading vehicle. Obviously, you can have long periods of time where liquidity is going up, asset markets are going down, and vice versa. But we know that, generally speaking, over time, if the blue line is rising, asset markets tend to rise alongside with that. And secondarily, we've done a lot of statistical analysis to understand what actually drives the global liquidity proxy. What are the variables both economically and in the financial markets that actually have meaningful relationships with changes in global liquidity. And one of those things we find is that when the dollar is declining on a coincident basis, it has a very strong inverse relationship to global liquidity. Same thing with the MOVE index, same thing with inflation, currency volatility. So my hypothesis on what's really driving that is that, when the dollar is declining in price, it makes it a lot easier for the bank, the foreign, commercial banking sector and non-bank sector to create dollar liquidity out of thin air. Obviously, more volatility makes that process a lot harder. And generally speaking, these, these net international investment surplus economies are the ones creating all the dollar liquidity out there. And so if we can have a sustained period of a falling dollar, which will drag currency volatility lower, which will ultimately drag bond market volatility lower, et cetera, you could have a sustained, uplift in the global liquidity. Now, again, that's not my central modal outcome view, but we're starting to see the seeds of something that looks like that in the recent weeks. And how sustainable is that going to be? I think, to your point, depends on the QRA we're going to get in January, and obviously the growth and inflation data we're going to get throughout Q1.
Yep. I don't have much to say. I don't place as much. I place some weight on this type of indicator. I don't place as much as you and Michael do. But if it works for you, it seems to give you an edge. Then have at it. For me, I prefer things that have more root causes than are statistical.
Mhm.
And I'd like to see the levering up of the banks when the US dollar falls, not some statistic that says that they often do.
Mhm.
And I don't see the need for banks to lever up and buy financial assets simply because they have cheaper dollars.
That makes sense. Well, Andy, this has been another fabulous tour de force, my friend. I always appreciate your time, your insights, man. I tell everyone the number one thing that I think you can do as an investor is surround yourself with people that have gray hair in this industry, because you cannot get good at this without experience and without reps. You can spend all day in Excel or Python or whatever the hell else program you want to use, but the reality is you need to earn those scars to be a good investor, and you are, my friend, a very good investor.
I appreciate it. Your work is incredibly strong. It's great to watch. Great to see you guys develop, and I think you have something special.
I appreciate that, Andy. Well, you be good, my friend. We'll catch you back here, everyone, next month. I'm always embarrassing myself at the end of this. I want to say, oh no, we got Warren Pies of 13
Oh, nice.
14 research. I want to say in December. So, and then followed by Jim Carson in January. So we got a stacked lineup for everybody. So we'll catch you back here next month, everyone. Happy Thanksgiving. Cheers.